The Committee on Banking, Housing, and Urban Affairs will come to order. Thank you all for joining us, Senator Scott. Thank you for your work. All of our work on safeguards for our banking system must come back to one goal: protecting Americans' hard-earned money in the bank, protecting American taxpayers. Because working people have been forced to pay for big bankers' bad decisions over and over. In the wake of three of the nation's largest bank failures in history, three of the largest in history, this committee held a series of hearings with failed bank executives, the bank regulators, and outside experts. It's our job to hold accountable everyone responsible for the gross mismanagement and risk-taking behavior of these bank executives that threatened the stability of our banking system. Out of that effort, this committee came together. Senator Scott and I worked hand in hand on this to advance a bipartisan bill that will hold bank executives accountable for their misconduct to help prevent future bank failures while protect consumers and taxpayers. The Recoup Act, the bill we passed 21-2 out of this committee, will ensure that executives who follow the Wall Street profit at all costs business model will not be able to cash out when their bad decisions threaten middle and working class families' financial security. The Recoup Act is an important and necessary step to prevent bank failures. This committee will work to get it passed into law. The collapse of the Silicon Valley Bank, of Signature Bank, of First Republic Bank illustrates why we need important guardrails on executives, on the way big banks operate. We need better protections, stronger capital liability standards, for instance, tougher stress tests, and more rigorous enforcement and supervision. The bank failures also raise questions about our federal deposit insurance system. That's what our hearing's about today. SVB and Signature ignored liquidity risk. They used overwhelmingly uninsured deposits, all concentrated in the same industry, to finance unsustainable growth. More than 90% of deposits at SVB and Signature were uninsured, more than 90%. That's about twice the average at Ohio's regional banks and far more than that at community banks. And when those bets don't pay off, venture capitalists triggered a social media-fueled bank run, a panic that led to consumers yanking $42 billion out of SVB in less than a day. Signature Bank lost $18 billion. When these banks failed, small businesses whose accounts were at SVB and Signature Bank from Ohio to Utah and across the country just wanted to make payroll. Ohio banks and credit unions didn't want to see their deposits flee to Wall Street mega banks. Regulators, both Republicans and Democrats, came together to prevent the panic from spreading, protecting consumer and small business deposits without taxpayer money. The recent failures were not the first time we've covered the losses of uninsured depositors. We used the systemic risk exception and temporarily expanded deposit insurance in the past, including during emergencies like COVID and the financial crisis of 15 years ago. We understand the need to protect depositors, promote confidence and stability in the banking system in a time of crisis. But it's also our job to make sure banking safeguards work for everyone, for consumers, for small businesses, for banks that serve their local communities, not Wall Street mega banks and big investors. Deposits serve a critical function in our basic banking system. They are the source of our money supply, the financing that banks use to make loans to middle and working class Americans looking to buy a home or start a business. Community banks play a pivotal role in making these loans. They maintain close ties with their communities. They have a vested interest in the customers whom they see and whom they serve every day. People know these bankers and trust them to use their deposits to invest in their local communities and make loans to their neighbors. Yet decades of consolidation and concentration have led to deposit flights to the Wall Street mega banks, stripping wealth from local economies. And over the past 20 years, the number of commercial banks has been cut in half. Today, only 14% of deposits are held by community banks. If customers move their deposits to mega banks because they think they're the only place the deposits are safe, has an outsized impact on investment in local communities, the local economies and communities, especially in rural communities where often community banks are the only commercial bank presence. And when regulators take action to protect uninsured depositors and prevent a crisis from spiraling out of control, those costs, like the special assessment to pay for the failures of SVB and Signature, should be borne by the banks that take on the most risk, yet somehow still benefit the most. We can't let Wall Street mega banks siphon deposits from smaller banks, then scoop up failed bank assets at a discount, then continue to grow unchecked. When we 90 years ago created deposit insurance, we promised Americans that reckless gambling on Wall Street wouldn't put Americans' hard-earned dollars at risk. Since then, every time a bank has failed, FDIC's made sure that uninsured depositors didn't lose a penny, and working American families have the confidence to keep their money in banks without fear of a bank run. The purpose of today's hearing is to understand whether our current FDIC framework continues to fulfill that promise. Our panelists come from diverse backgrounds. I thank the three of them for joining us and present unique perspectives on what changes, if any, should be made. We need to make sure deposit insurance protects small savers, workers, and businesses, and promotes competition, confidence, and stability to work in the banking system, in community banks and credit unions and regional banks, not just the big investors and the big mega banks. We also need to make sure that the rules banks have to follow to prevent bank failures are strong enough too. Because make no mistake, increasing deposit insurance coverage without putting in place stronger guardrails is akin to throwing a lit match onto a pile of dried leaves. Changing deposit insurance is not a cure-all, to be sure. It's a complement to stronger financial regulations and banking supervision, sending a signal that the financial industry can make risky bets with abandon, and if their banks fail, the government will always pick up the tab, will only lead to more failures, more financial crises. We've seen what happens when big banks don't properly manage risk and build up sufficient capital. Too often, it's always workers who face the consequence. Every time Wall Street crashes our economy, we put tougher guardrails in place, protect workers and consumers and preventing from happening again, as we should. But then lobbyists go to work, watering down, sometimes erasing altogether important financial safeguards. We can't make changes without first undoing the rollbacks of financial safeguards that have reduced bank supervisors' ability to police unsafe practices and to ensure the biggest banks have sufficient capital and liquidity. Our financial watchdogs must work to strengthen our system, help our economy grow, support local communities, ensure working families and small businesses' money is safe. Senator Scott.
Thank you, Mr. Chairman, and I look forward to hearing from each and every witness this morning, especially Mr. Ullman. Welcome back to the committee. I know that you were here under Senator Shelby, and we certainly miss Senator Shelby, but appreciate your expertise and your wisdom coming back to the committee, and good morning to both of the other witnesses as well. Deposit insurance is incredibly important. It's an incredibly important issue and one that plays a large role in ensuring the ability and the stability of our financial system, and one, frankly, that is top of the mind as of recent months. Any American who walks into a bank and sees that very recognizable FDIC-insured sign knows with certainty that they have up to $250,000 of their accounts covered by that insurance. And they're safe because the government protects those deposits from loss. In fact, over 99% of all deposit accounts are fully insured under the FDIC. And if the FDIC likes to say, not a single penny of insured deposits has been lost at all since 1934. However, in March, deposit insurance was thrust into the limelight when it played a key role in stabilizing our economy and making sure our account holders were safe in the wake of 3 historic bank failures. Our government took extraordinary measures to cover unprecedented amounts of uninsured deposits. These bank failures, still fresh in our minds, brings us here today, where we hope to hear about various perspectives on deposit insurance and whether our current deposit insurance regime is appropriate or if changes should be made. It's not an understatement to say that deposit insurance is a complex issue that deserves a thorough evaluation, and what legislative response may be necessary, if any, because when it comes to proposals to reform the system, there are a number of trade-offs we must consider, and frankly, even scrutinize. Nothing in life except for faith is free, and it is worth noting that none of the proposals we'll discuss today come without a cost. The bill always comes due, and someone always has to pay for any proposed increases that have been floated around its possibilities. Furthermore, the costs of these increases will most likely be borne by our small businesses and everyday consumers in the form of higher fees and potentially decreased credit availability. And like with any proposal, we must evaluate the benefits and the burdens. Any potential reforms will not operate in a vacuum. We have to look and understand how our existing deposit insurance regime works and really see how it interacts with our broader financial system as a whole. It is also important to question whether a response to supervisory failures should be included in reforms to deposit insurance or in accountability measures for our regulators. As I've said from the beginning, and even in this committee's recent markup of the Recoup Act, consumer trust and confidence demand a high price. And it's incumbent upon us in Congress to deliver safety and soundness for the American people in both our businesses, but also with our regulators. And finally, we must also take broader societal and technological changes into consideration as we discuss deposit insurance. Silicon Valley Bank's collapse was the first social media-fueled bank run. I think we all saw on Twitter the flight of $40 billion in deposits in just a single day. The increasing influence of social media means that we now live in a world where any message can be spread nearly instantaneously with billions of people. Financial innovations such as online banking and faster payment systems mean that people can move their deposits very quickly with just a few clicks. Like all things, there's positives and negatives to that. And just as we must consider deposit insurance reform in the context of supervision and regulation, we must also consider the impacts that rapidly advancing technology have on the system and whether a system designed in the 1930s still works in the 2020s and beyond. In the end, we must focus solely on the American people and what is best for them. By doing so, we can foster an environment that encourages responsible banking practices and secures the financial futures of all Americans. I look forward to hearing and learning more from our witnesses today to help inform the committee's members on potential paths forward for maintaining confidence and diversity in our banking system.
Thanks, Senator Scott. I'll introduce today's witnesses. Today we'll hear from Emily DeVito, the Senior Program Manager for Corporate Power at the Roosevelt Institute. Welcome, Ms. DeVito. Tom Fraser, CEO of First Mutual Holding Company and town community not far from where I live in Lakewood, Ohio. Mr. Fraser, welcome. Mr. Andrew Ullman, partner at Sherrod Brown. Ms. DeVito, please begin.
Chair Brown, Ranking Member Scott, and members of the committee, thank you for inviting me to testify at this hearing. My name is Emily DeVito. I'm the Senior Program Manager for the Corporate Power Team at the Roosevelt Institute, an economic think tank. I'm here to discuss the slate of reforms to federal deposit insurance that have emerged following the recent bank failures. Deposit insurance has been a linchpin to U.S. financial stability and a godsend to otherwise anxious depositors since the Great Depression. Funded through risk-priced fees that banks pay into the Deposit Insurance Fund, deposit insurance offers eligible bank customers peace of mind so that they are not inclined to hurriedly withdraw their deposits. It acts as a stabilizing force for the entire banking system. Most of the time, just the promise of government guarantee keeps banking stable. But as the failures of Silicon Valley, Signature, and First Republic banks demonstrated, uninsured depositors can still panic. And when they do, especially if they're businesses with large payroll accounts, that panic can quickly spread to workers, families, and the entire financial system. Following the recent bank collapses, experts offered several proposals to strengthen our financial system through deposit insurance reform. I synthesized that range of proposals in a recent brief for the Roosevelt Institute. When taken together, three main approaches emerge. The first approach to deposit insurance reform would mostly preserve the current system as is. It holds that the current system is already working as intended since bank runs are rare and the vast majority of individual and small business depositors are fully insured. Moreover, this approach argues that any significant changes to the deposit insurance status quo could actually engender more harm than good by incentivizing risk-taking by banks. To the extent that the recent bank crises call for policy reform, this approach advocates for hyper-targeted tweaks to inject more resiliency into the system, through, for instance, linking the coverage limit to the price level or instituting temporary emergency provisions. While this approach would be least disruptive to the current deposit insurance scheme and would be least costly to the DIF, it would also largely preserve any threat of uninsured depositors to financial stability. A second approach would be to expand coverage for certain accounts. This approach, favored by the FDIC, seeks to target accounts that don't earn interest for additional coverage, as they're unlikely to monitor bank behavior in order to bring market discipline to bear, but they can trigger bank runs. Such an approach would be particularly beneficial to the small and mid-sized businesses that need large accounts to meet operational and payroll costs, as well as to the employees who depend on them. However, this approach would add a degree of complexity to deposit insurance that could be difficult for the FDIC to enforce and difficult for banks to communicate to customers. It would also result in some costs to the deposit insurance fund, but how much depends on design. A third approach would be to enact universal and unlimited coverage. This proposal maintains that U.S. banking will be vulnerable to acute crises as long as uninsured depositors exist, and so advocates for universal and unlimited deposit insurance. Proponents also argue that unlimited coverage would align the law with current practice, as there is growing implicit understanding amongst depositors that U.S. policymakers are likely to err on the side of caution in times of financial crisis to backstop at-risk deposits. Fundamentally, this approach seeks to reckon with questions about the relationship between private financial institutions and the federal government, ultimately pointing to the need for alternative public banking infrastructure. This approach would virtually eliminate run risk, but could potentially increase bank risk-taking and potentially result in large costs to the deposit insurance fund. Additionally, a safe and sound banking system requires strong regulation and supervision at all times. Enhanced regulatory, liquidity, and capital requirements would help maximize deposit insurance's efficacy in protecting depositors and stabilizing the financial system. And independent of deposit insurance reforms, strengthening our institutions and regulatory environment would mitigate moral hazard. Separate from successfully passing and implementing any particular deposit insurance proposal, having debates on these underexplored questions is a valuable exercise that benefits U.S. financial institutions and the millions of depositors, namely businesses, workers, families, and communities who rely on them. I commend the committee for hosting a hearing on these topics. Thank you again for inviting me to testify. I look forward to your questions.
Thank you, Mr. Vito. Mr. Fraser, welcome.
Thank you, Chair Brown, Ranking Member Scott, and members of the committee for the invitation to testify today at this hearing. I deeply appreciate the opportunity to provide you with my views on deposit insurance reform and the perspective of the banking industry. I am Thomas Fraser, CEO of First Mutual Holding Company in Lakewood, Ohio. First Mutual is a $2.9 billion no-stock private mutual holding company with 5 mutual banks ranging in size from $30 million at the smallest and to $2 billion. Our banks serve Ohio, West Virginia, Kentucky, and Virginia. We provide safe access to banking to consumers and small businesses in Appalachia, the industrial Great Lakes, and underbanked urban neighborhoods in Cleveland and Cincinnati. There are about 425 mutuals, or 8% of the banking charters in the United States, split evenly between federal savings associations and state chartered banks. All are less than $10 billion in assets, and most are less than $250 million in assets. Mutual banks tend to be concentrated in New England, the Mid-Atlantic, the Great Lakes, and the industrial Midwest. With no shareholders, mutual banks are tax-paying cooperative entities owned by our members, providing the same services as other stock banks. We are subject to the same regulatory rigor and oversight as any other bank. For perspective, most of the mutual industry customer deposits are fully insured. Only 24% of mutual bank deposits are uninsured, and over 83% of my 5 banks' deposits are fully insured. We believe deposit insurance is an important part of the banking social contract with our owner, customers, and community. In exchange for this, our banks lend to those insured deposits on a fair and equitable basis and operate in a safe and sound manner. Deposit insurance is an important safeguard in that way. Management teams, though, myself included sometimes, are tempted to view deposit premiums as an expense or a tax. They're not. In reality, it's a powerful consumer protection tool that reinforces our stable deposit bases, and it's not an entitlement to bankers. Depositor confidence is critical to the banking model. The events of this past March raised some questions about the stability of the industry's deposit base for several days. Since then, however, bank deposit bases have held up really well. Deposit insurance has performed as expected as it has for the last 90 years. And customers fundamentally, after a few days of uneasiness, understood that our business models and the risk profiles of local and regional banks were significantly different than those of the failed banks' exotic business models and excessive risk-taking. I agree with the opening comments today by both you and Ranking Member Scott about the causes of the failed banks that happened. And ultimately, those banks had vulnerable deposit franchises which were susceptible to new trends in technology, gutting their unproven and dangerous business models. It has become evident to me that a structural shift in banking is occurring, and there's a range of new emergent risks that did not exist in the '08 financial crisis and certainly didn't exist in 1934. And these contributed to the failure of those banks. Those 9 risks are discussed in detail in my written testimony, and essentially they're challenging the perimeter of traditional perceptions and mechanics about how our financial system works. It's imperative that banking policy adapt to these new risks, especially with respect to deposit insurance reforms. I respectfully urge this committee and Congress to focus on the following when discussing deposit insurance reforms. While many proposals focus on identifying impacts of moral hazard risk-taking, who bears the cost, who rides free, who wins, who is harmed, deposit insurance reforms, however, should remain centered on impacts to consumer protection and the stability of our banking system. Bankers and policy should maintain those two as our highest objectives. Reform options should also account for emergent factors outlined in my written testimony and rigorously assess unintended consequences of making policy changes. Those risks can grow and fester unchecked with outdated policy tools, and I'm worried that implied guarantees can continue to grow as non-bank shadow market participants conclude that insurance someday may be inevitably applied to their activities. Finally, with respect to FDIC receiverships, resolution should also consider long-term competitive concentrations beyond just expedited, low-cost FDIC resolutions. FDIC has proven an effective insurance provider and manager of banks in receivership. Congress should consider providing FDIC with additional stand-in tools beyond just the systemic risk exemption to resolve failed banks in a manner that does not cause deposit or asset concentrations in large institutions after a crisis. In conclusion, no regulatory scheme nor deposit insurance reform can totally account for excessive risk-taking, poor management, and bad behavior. But I respectfully request that this committee keep the tenets I've expressed here in mind as possible deposit insurance reforms are discussed, particularly with respect to consumers and systemic risk. Our objective should be, as policymakers and bankers, to minimize unintended impacts, protect consumers and businesses, and perpetuate confidence in the banking system. Thank you once again for the opportunity to testify before the committee, and I look forward to answering your questions.
Thank you, Mr. Frazier. Mr. Ullman, welcome.
Chair Brown, Ranking Member Scott, and the members of the committee, thank you for the opportunity to return to the committee and to testify today on the potential options for reforming the Federal Deposit Insurance Program. I commend the committee for taking up this important issue. Deposit insurance is one of the key pillars of the U.S. financial system, and its continued operation is critical to maintaining a safe and sound banking system. Any potential deposit insurance reforms need to carefully balance 2 competing policy objectives. Any reform will first need to uphold the deposit insurance program's statutory mission to protect the savings of everyday Americans and help prevent bank runs. At the same time, any reforms also need to avoid creating moral hazard that reduces incentives for proper risk management. When the deposit insurance program has struck the right balance, it has fostered a stable banking system, yet when moral hazard risks have been neglected, the result has been bank failures and even banking crises, such as the savings and loans crisis. In response to recent failures of several prominent banks, the FDIC has produced a very thoughtful and balanced report that evaluates several deposit insurance reform options. The full report deserves the committee's consideration. Of the reforms discussed in the FDIC's report, the targeted approach merits the most study by the committee. Under the targeted approach, deposit insurance would be increased only for certain business transaction accounts. A related approach that also deserves consideration would be to grant small businesses the option to purchase additional insurance. However, the FDIC would need to take extra precautions to properly price such insurance to avoid adverse selection risks. The benefit of these approaches is that they may reduce the probability of future bank runs by covering payroll accounts. As the FDIC notes, small businesses appear to be more likely to withdraw their deposits at the first indication of problems with their banks, more so than other depositors, due to the consequences of not being able to make payroll. However, I would caution the committee about significantly increasing the overall level of deposit insurance. Instead, if it decides to increase limits for one type of account, it should consider offsetting that increase with a reduction for other accounts for 2 reasons. First, the increased cost to provide additional insurance would come at a time when banks are already bearing very heavy regulatory costs. Higher operation costs for banks risk pushing more activities outside the banking system. And second, increasing the total deposit insurance coverage limit also undermines the FDIC's least cost resolution requirement. In the wake of the S&L crisis, Congress, and more specifically this committee, enacted the least cost resolution requirement to protect against moral hazard by limiting the FDIC's ability to protect uninsured depositors. However, each increase in the deposit insurance limit increases the amount of support that the FDIC can provide under the least cost resolution requirement. In its report, the FDIC notes this fact and revealed that since 2008, when the deposit insurance limit was raised to $250,000 from $100,000, uninsured depositors suffered losses in only 6% of bank failures. In contrast, uninsured depositors suffered losses in 43% of bank failures during the period from 1992 to 2007. Accordingly, even though the use of the systemic risk exception to protect the uninsured depositors of Silicon Valley Bank and Signature appear to be exceptional events, these figures show that their uninsured depositors were simply treated in the same manner as uninsured depositors in 94% of bank failures. The treatment of uninsured depositors deserves far more study to better understand both the contagion risks that they may present and the consequences of the apparent reduction in market discipline in the way the FDIC resolves failed banks. In my written testimony, I discuss in detail several other issues that deserve the committee's attention. Here, however, I want to highlight one that Ranking Member Scott brought up in his opening testimony, the impact of technological change on the deposit insurance program. The recent run on Silicon Valley Bank revealed how the emergence of digital banking now allows depositors to move their funds at speeds unimaginable when the Federal Deposit Insurance Program was created. As noted earlier, Silicon Valley Bank received deposit withdrawal requests of approximately $42 billion in an 8-hour period through the use of digital banking, fueled by commentary about Silicon Valley Bank on social media. Although Silicon Valley Bank may have had a more technologically savvy depositor base than most banks, it's only a matter of time before more banks face this issue as digital banking becomes even more pervasive. The advent of digital banking certainly promises great benefits to consumers in terms of efficiency, convenience, and cost. However, it is critical that the deposit insurance program keep pace with ongoing technological change. Further study is needed to determine what implications these technological changes have on the stickiness of deposits, the potential speed of bank runs, and the overall stability of the deposit insurance program. Thank you again for the opportunity to appear before you today. I would be happy to answer any questions you may have.
Thank you, Mr. Ullman. Appreciate your being here. Ms. DeVito, I'll start with you. Senator Scott said, and factual, no depositors ever lost a penny on uninsured deposits in 9 decades, but we've seen several systemic risk events during the 2008 financial crisis and the recent bank failures. The failure of First Republic resulted in increased concentration at the biggest bank in the country, way above the 10% cap, perhaps. What did these events, Ms. DeVito, reveal about the strengths and weaknesses of our banking system and deposit insurance framework? How do other bank regulatory policies help protect depositors and financial stability?
Thank you, Senator. So the crisis this past spring suggests that there are at least, I think, 3 underlying vulnerabilities in our banking and deposit insurance systems. The first is that it revealed depositors are incredibly flighty under the current deposit insurance terms, and that these depositors can threaten financial stability. The second, I think, is that it casts doubt on how effective depositor discipline is right now. We saw with SVB that even large depositors don't currently seem incentivized to or capable of policing banks the way we would need them to maintain financial stability in the long term. And third is that it does seem to be exacerbating rising bank industry concentration through both mergers, as Mr. Frazier mentioned, and deposit flight. If uninsured depositors at smaller banks feel they need to go to larger banks to get that sense of perceived safety, that can exacerbate bank industry concentration as well. In a vacuum, as deposit insurance expands, it removes incentives for depositors to monitor banks. But depositor discipline is only one input into overall market discipline for banks. So bank regulation and supervision play a really strong role in ensuring that banks are operating safely and soundly.
Thank you, Mr. Frazier. When people put their money in a bank, we want it to be reinvested in the community. We want it obviously, most importantly, to be safe. Talk about why deposit insurance is important to consumers and small businesses, also how it's critical to the role of community banks like yours.
Thank you, Senator, for the question. And deposit insurance is part of a backbone of what I call the banking contract that we have, and it requires banks to operate in a safe and sound manner, to protect consumers and small businesses especially, and to facilitate and provide access to credit. So deposit insurance enables that, along with access to other liquidity sources and such. To the extent that consumers can rely on that and they understand that, then banks have that obligation to perform those three activities I talked about. I am growing increasingly concerned, however, about the rise of bank-like services that have the attributes and look and act and talk like a bank and create consumer confusion. And in particular, about 45% of the accounts opened just this year alone are in these bank-like entities, and I'm worried about where that boundary line is.
Thank you. Back to you, Ms. DeVito. Over the weekend, the SVB failed. I talked to many small Ohio businesses who were worried about their ability to make payroll. What are the benefits of expanding deposit insurance coverage for all demand deposits, and what are the downsides that we need to account for and other policies that might mitigate those concerns?
One of the most important benefits to expanding deposit insurance is that it would reduce the likelihood that depositors panic, and so reduces the risk of bank runs. If deposit insurance were to be expanded, for instance, to all non-interest-bearing accounts, which represent accounts that people use to keep their money safe and accessible rather than as a source of investment, then any depositor with balances over the cap would benefit. Minimizing the number of depositors who could initiate a bank run would enhance financial stability objectives as well. Some of the downsides include that as deposit insurance expands, you could increase moral hazard. This effect, though, could be offset through other mechanisms such as tightening banking regulations and supervision, revisiting capital requirements and liquidity regulations in particular. And then coming to consensus on eligibility is a challenge. We need to make sure that whatever terms to FDI reform occur are enforceable through the FDIC and verifiable and communicable by banks to customers and by the FDIC to banks.
Thanks. Last question, Mr. Fraser. Uninsured deposits have been trending upward since the 2008 financial crisis, as you know. We've seen more migration to non-banks, as you point out in answer to the last question, and shadow banks that are not insured or regulated like traditional banks. What risk does this pose to consumers, banks, and the whole financial stability of our system?
Right. It comes down to where expectations begin to evolve about what is insured and what's not insured, and what can happen when deposits migrate outside of what I call the regulatory perimeter, that is to outside of where there's oversight, where a regulator, a prudential regulator can monitor those activities related to consumer protection and safety and soundness. There's a risk for customers to suffer adverse behavior or things in that regard. But more importantly, it poses risks outside of the system so that if a non-bank entity were to fail, a payment processor or someone were to fail, what are we going to do as policymakers to solve that problem? And I think as we think about deposit insurance reform, the lines need to be bright and clear as to what's inside the perimeter and what's outside of the perimeter. And I could tell you a quick anecdote about that, but maybe I'll do it separately, where we had a customer of ours go to a payment type system and said, I'm not worried about it because I expect if something goes wrong, someone will bail us out and help. So that expectation's evolving, and I think we just got to have a bright line as to what's in and what's out.
Thank you. Senator Scott.
Thank you, Mr. Chairman. Mr. Ullman, good morning again. Good morning. Well, yeah, listening to the witnesses talk about increasing a benefit. Increasing benefits almost always sounds good, especially if there's no downside or cost associated with increasing the benefit. With the FDIC, if you increase the amount of deposits that are exposed to insurance, then you have to increase the amount of a percentage of those deposits held by the FDIC. And so there's always an offset to the new benefits. Someone has to pay for it. That's kind of how I see the system. That's how the system works. So let's say we were going to increase the amount of insurance from $250,000 to some number, any number, but a much higher number. that doesn't come in a vacuum. It's not an isolated incident. When you increase something, you're going to decrease whatever it is in that marketplace called reality, where folks who want to have access to more loans, more opportunities, more small businesses, whatever it is that you're going to do with the money that's now held as an insurance policy for the failure of whatever it is a cost associated with it. Consumer confidence, of course, is paramount. We're trying to figure out how to thread that needle. It seems to me, though, that there is no increase without an expense. Can you talk to me a little bit about the positives and the negatives? Do the benefits outweigh the downside?
Sure. There's always, I think you're getting into the crux of the issue here, which is that deposit insurance provides some financial stability, right? It helps prevent bank runs and overall can increase the confidence in the banking system. And that's the positive side of deposit insurance. The other side, though, is that, as you point out, there are the costs. The first is clearly the additional insurance premiums. Remember, these insurance premiums also have to be priced according to the risk, so that there really should be kind of no free lunch, to use the old Milton Friedman phrase, that it covers the full cost of that insurance that's provided. For some banks, though, that cost is just simply not worth it for their business model. Two is the other kind of distortive effects that guarantees like deposit insurance can just play in the financial system. And that's kind of creating the moral hazard. It reduces the risk for other participants in the financial system to do their own due diligence. And as a result, over time, that lacking proper risk management can lead to additional bank failures and larger losses. The history of the S&L crisis is a great example to always remember that if the deposit insurance and overall regulatory policy gets the incentive structure wrong, so it can create severe moral hazard and result in banking crises, and frankly, this institution having to write a big check. Because at the end of the day, taxpayers are behind the FDIC. So everything we do also has to be kind of very mindful of the moral hazard risks that you potentially are creating.
And I'll say I certainly have received dozens and dozens, if not 100 phone calls about different scenarios on how to increase the deposit insurance. It's in a risk scene. Maybe you've received a call or two? Yeah. A lot of ideas out there, and perhaps some even merit consideration on ways to do so without necessarily increasing the deposit insurance, but taking away some of the percentage increase on the deposits held beyond the 250. So really interesting ideas out there. But one of the questions I've come to want to ask is on the commercial exposure versus the individual. Some have suggested we maybe bifurcate the FDI insurance, and there are some depositors that have so much in the deposits in their accounts that they need a special kind of FDIC because of the commercial relationship that they have with their clients, customers. Any thoughts on that bifurcation, if it's possible? Is it smart?
Yeah, we have it a little bit already because the limit for 250 is far in excess of what the average Americans have, which is a little over $40,000. So for the vast majority of Americans, deposit insurance works very well, and I think that's again a bedrock of our financial system. Most Americans, I think, don't have the ability to monitor their banks as effectively as other market participants. However, larger corporations, investors, other banks do have that capability, and that provides a strong market discipline on banking banks, and I think that is actually a good thing for good bankers too, right? Good bankers have a reputation for effective risk management, and that attracts those customers to those banks. And one thing, the kind of cost you have to watch out for is increasing the deposit insurance can also create competitive disadvantages in the marketplace. Again, bankers who are good at risk management can compete on that fact. If you, say, went to a system where you had unlimited deposit insurance, the only way consumers, large or small, sophisticated or unsophisticated, would determine would largely be on yield. That can create a very perverse incentives for institutions, particularly those may be troubled, to raise interest rates to attract deposits. And then if they ultimately fail, again, that's a larger hit to the deposit insurance fund. That's a little bit what happened with the S&L crisis.
Thank you. Now, I know that the chairman went over by about 4 or 5 extra minutes, so I won't do that to you all. But just,
Nice try.
yes, thank you very much. You got to try something here. So just for a perhaps not even a response, just I'll throw this out to the panel, and perhaps we'll answer it at another time. The bank run that was created in part by social media is something obviously we had never seen before. $40 billion in 24 hours. I think the last time we saw a bank run, it was a third of that amount over 6 weeks or so. I'd love for us to contemplate what types of changes that are necessary because of technological evolution that we're seeing in this nation and how we try to insulate our financial systems going forward. But, Chairman, because I'm very sensitive to time and going over, I'm going to stop there.
This is not Iowa time. This is Washington.
That's just a low
Menendez of
blow.
New Jersey.
That was just unnecessary, Mr. Chairman.
Thank you, Mr.
But that was
Chairman.
funny. I'll get you back later, though.
The FDIC's favorite approach to deposit insurance reform is to expand insurance limits for certain types of accounts, such as business payment accounts. And I think that idea has a lot of merit. But one of the challenges with this option is that we would need to rigorously define the universe of accounts that would achieve increased coverage. Mr. Vito, if Congress were to take this approach, what are your thoughts on how to tailor increased coverage and what type of accounts should be included?
Thank you, Senator. I've heard several proposals for doing just that. One approach would be to expand coverage for all non-interest-bearing accounts, as these are accounts that don't earn interest and so don't serve an investment function. Other proposals include lifting transaction accounts specifically, and so, or in using the FDIC's terminology, I think they're getting at business payment accounts, which they admit doesn't have like a clear statutory definition, but one could be teased out that increases coverage for business transaction accounts. And then I've also heard proposals to predicate expanded coverage on small and medium sized enterprise employment. So something that would predicate expanded coverage on being a small business employer under a certain amount, 200 or so employees.
Mm-hmm. The goal of such an approach is to provide stability by fully securing the deposits that business rely on to function without significantly increasing moral hazard. However, if we don't carefully define the types of accounts that need increased coverage, we could see costs to the deposit insurance fund increase without commensurate stability benefits. How can we ensure that a targeted coverage increase is properly tailored? And would the FDIC need additional flexibility in order to implement that type of tailoring?
Senator, I can't speak to, I guess, FDIC authority in this matter, but I certainly agree that getting the definition right and making sure that these are distinguishable terms for the FDIC to be able to verify and enforce, and for banks to be able to communicate to customers is the real way to enhance the financial stability objectives of deposit insurance.
Now, I'm curious and potentially worried about the effect of increasing deposit insurance would have on smaller banks. For example, under the current deposit insurance framework, businesses and individuals with more than $250,000 in deposits are encouraged to diversify their deposits across multiple banks to maximize coverage. If Congress were to increase deposit insurance, would you expect deposits to concentrate at a small number of banks?
I think that actually enhancing bank competition could require, in view of deposit insurance specifically, reform that expands coverage to allow these small and community banks to better compete against very large banks. Right now, you might have a sense of implicit universal coverage if you bank at a very large institution, because they might be the most likely to get bailed out if they fail. And small and community banks don't enjoy that same privilege. So increasing coverage for certain uninsured depositors could be a way to allow small and community banks to better compete.
Mr. Fraser, what impact would some of these proposals have on smaller banks in particular?
Yeah, smaller banks in particular. So there's a formula FDIC uses that we calculate quarterly to determine our deposit insurance premium. And that's manageable. And so the data tracking is an important consideration. How would we go about calculating it? How would we comply with a new insurance regime? And the cost of doing that is something we would have to think through. That would be one. Secondly, deposits in the aftermath of SVB, they did flow. There was a lot of slosh back and forth in and out of institutions. Some more sophisticated customers fled to the safety of T-bills, and they were able to do that via Treasury Direct. We're also seeing behavior change among corporate treasurers. They're far more active. So there were one or two notable cases at Silicon Valley Bank where everyone had their deposits in one institution, or company did, and that was a massive problem. We're seeing corporate treasurers being more active. So armed with better technology, this is the good side of it, is business owners can make good choices about where to place their large deposits. Generally speaking, for my banks, and we're $3 billion and under, we don't see too many corporate accounts or larger depositors beyond that $250,000 threshold today. So I think there'd be a minimal impact for the smallest banks, but it is a complex institution, and I think the data is not fully clear as to what it would suggest.
I appreciate that. While increasing deposit insurance may be necessary in order to preserve financial stability, encouraging consolidation carries its own risks. Research from the Federal Reserve indicates that the banking desert are increasingly prevalent, particularly since the pandemic. So I think we need to be mindful of actions that could further decrease diversity in the banking sector, leading to further closures and consolidations that leave families without access to banking services and further concentrate risk into large institutions. I look forward, Mr. Chairman, to working with you on these issues.
Thanks, Senator. Senator Vance from Ohio.
Thank you, Mr. Chair, and I want to thank everybody for being here, but especially Mr. Frazier from the great town of Lakewood, and appreciate you being here from Ohio. So I want to ask a little bit just about how the recent banking crisis and some of the services that it issued affect Main Street banks, and in particular your bank, Mr. Frazier. So one of the things that I've continuously highlighted since the failure of SVB and a couple of these other institutions is the importance of the three-tiered banking system and the benefits that community and regional banks have on the economy. Now, of course, talking about banks like yours, but all across the state of Ohio and all across the country. Maybe just to sort of set the stage a little bit, Mr. Frazier, I want to ask, who do you compete with on deposits, right? If you're not getting these deposits, where are they going?
Yeah, so we've always competed in the community bank space and with regional banks in Ohio. And a little bit of the context of the state of Ohio is we have 175 charter banks, several regionals, and about 240 banks that operate in our state. So it's always been, it's kind of the crossroads of America when it comes to banking. Everyone's in Cleveland or Columbus and in our different 88 county seats. Sure. And so that three-tier system works well. Like, we will hand customers up when they get too big for us to a responsible regional. In the same way, if a regional has a customer that needs maybe a little bit more intimate attention, we'll step in and do that. And the regionals, I'm sure, do that with others. So we have a healthy three-tiered system. And we're seeing increasing flight or competition right now for deposits with non-bank players coming in offering bank-like services. We're seeing some larger customers, I mentioned earlier, seek the safety and easy and high levels of returns right now with treasuries. And those dollars come out of the banking system when they leave a bank, and if they're parked overnight in a treasury or in a money market fund. Non-banks exist in that space, and those balances are big. I think there was about $1.7 trillion in reverse repos last night. All of those funds come out of the banking system and cannot be used to make a loan, and it drives up the marginal cost of deposits for individuals. The other part, too, is those money market funds don't pay the 8 basis point premium either, and right. I worry about what would happen if one of them had an issue, or one of them needed an assistance, or if a payment processor did, as I had mentioned earlier.
Yeah. Well, and one thing, Mr. Frazier, I mean, both with the money markets and some of the fintechs you're sort of referencing, but also, we've seen some flight to deposits, flight to safety from depositors to some of the bigger banks, right? Because the bigger banks contain this sort of implied promise of bailout. My fear here is that if you're a local business and you've got a few $100,000 of uninsured deposits, then you're going to put them in a big bank because you know that there's this implied guarantee of an unlimited deposit insurance. That's obviously not something that your bank benefits from. Could you speak maybe just to the importance of the three-tiered banking system? Why is this important Why is it important to have banks of all sizes in the system that we have? Obviously, you see that up close and personal in Ohio.
Yeah, the three-tiered system is critical. So it allows us to reach into and provide better service tailored by bank size and bank type to the needs of individual consumers or businesses of different sizes. For instance, we couldn't handle a $100 million credit facility, but regionals working together could. And that's important. And success stories are when small businesses become bigger and we're able then to move them along in our banking system to those that can handle their needs. So that is critical. More importantly, though, having a tiered system allows more responsive community action. So we have a bank in Parkersburg, West Virginia, one of our 5 banks. It's small, but it provides a critical role in supporting people locally there. And watching the traffic up and down West Virginia 2 or Ohio 7 along the Ohio River, we see these banks able to respond to the immediate local needs of that community. And then in the same way, 200 miles downriver in Cincinnati, we have a mutual bank that's decided because of how it serves, who it serves, and who it represents to become a minority depository institution and able to reflect the values of that community.
So Mr. Frazier, could I just one final question here, because I know I'm short on time, and I apologize for the interruption, but we just introduced today a piece of legislation, the Payroll Account Guarantee Act, and the basic idea is that we want to increase deposit insurance for non-interest-bearing business transaction accounts. The idea is that if you have a few $1 million that comes in at the end of the day in accounts receivable and your bank collapses, you're not penalized for this. You're not, in other words, we're not penalizing businesses for using a bank as a bank. This is much different, of course, from the Silicon Valley bank accounts, many of whom put hundreds of millions of dollars of uninsured deposits for a very long time. I'm curious, would extending the transaction account guarantee program, which existed for some time but has expired, would that help your bank and would that help the banking system in Ohio?
Yeah, I think in theory that the concept of expanding deposit insurance or targeting as different proposals have suggested is something worth considering, and it has merit, as do some of the other approaches there as well. And I think it's a good start, and it's a good place to begin the deeper dive into it. I'd also think about when we go about any proposal, the items that the other witnesses have talked about are important, and also to the 9 different factors that have emerged that are different that should be considered that are in my written testimony. I would think that would be a helpful tool to and lens in which to evaluate those proposals.
Of course. Mr. Frazier, thanks for being here. Thanks for everybody else.
Senator Smith of Minnesota is recognized.
Thank you, Mr. Chair, and thanks to all of you for being here. I appreciate this very much. So Minnesota is home to about 300 community banks. I think it's about the highest concentration in the whole country. And these banks are small, but they're extremely important and really deeply rooted in their communities and mean a lot to the people and businesses who they serve. So I was really pleased to see the FDIC exclude banks with less than $5 billion in assets from the special assessment to replenish the deposit insurance fund following the collapse of the Silicon Valley Bank and Signature. Mr. Frazier, this question is to you. Can you just talk a bit about why it's important to make sure that smaller banks aren't burdened by this special assessment?
Yeah, thank you, Senator. And it depends on that burden. And I think you pointed out the $5 billion exemption on the special assessment. And I know a couple of mutual bankers in Minnesota, and one in Lake City. In fact, I had a discussion with the other day, and we were pleased to be excluded from the assessment because we didn't think we were involved or any of the root cause. But so it depends on where you sit.
Right.
But given that, I'm worried not about this exception, and I'm pleased to be excluded, as are all the other banks, but that are in our size. But I'm worried about the next event if we don't have any reform or think through how and when those special assessments are, and if it's a bigger event, will we all bear that burden? And earlier today, I talked about that responsibility we have as bankers to provide credit and to operate in a safe and sound way, and to protect our consumers and operate in a fair and reasonable way. That could be called in question a little bit if we don't think through what the next event's going to be.
Right. Thank you. I appreciate that. And it's complicated, right? Because we don't want to create a moral hazard where there's, everybody has like unlimited deposit insurance, and therefore, what the decisions that you make don't matter. Ms. DeVito, thank you for being here. It seems to me that Silicon Valley Bank and Signature Bank, they not only took big risks, but they treated risk management like a total afterthought, honestly. And that isn't how most small banks and community banks operate. The deposit insurance fund assessments are based on risk, and that includes a consideration of a bank's supervisory rating. But the Fed and the FDIC reports on the failures of Silicon Valley Bank and Signature respectively found that supervisors were slow to downgrade ratings after deficiencies were identified. So can you talk about, does this mean that SVB and Signature contributed less to the deposit insurance fund than they should have? And how important is it that you have strong, effective supervision to maintaining adequate funding of the deposit insurance fund? How does that work together?
Thank you. I don't have the figures on SVB's contribution to the deposit insurance fund specifically, but I think a lot of experts have been concerned for a while that banks are being underassessed. The deposit insurance fund was below its statutory minimum going into this crisis. So I think there's some desire there to bring it up to a threshold that is a little bit more nimble to manage losses through crisis. That said, I think there could be ways to more progressively assess based on risk, including maybe going forward on concentrations of uninsured depositors. Those formulas tend to be very complicated, and I don't want to be overly prescriptive, but there are definitely ways to make sure that it's a more progressive assessment.
So you think that there could be room to restructure assessment rates and methods so that less risky institutions like small banks and community banks aren't paying more than their fair share?
Yes, ma'am. I think we need to look at concentrations of uninsured deposits and certainly overall systemic risk, and make sure that those scorecards that the FDIC uses are updated consistently and well.
Mr. Frazier, would you like to comment on that?
Yes, Senator. I think it's really important that risk management practices are embedded in any kind of assessment changes that may occur. I think bankers of all stripes want to pay their fair share in this. I mentioned earlier, we don't view deposit insurance as a tax or an expense, but as part of providing safe services to our community and having reinsurance. And I think that will be critical to the stability of the fund going forward.
Thank you very much. Thank you, Mr. Chair. I yield back.
Senator Warner is recognized from Virginia from his office, I believe.
Yeah, thank you, Mr. Chairman. I apologize about not being physically with you all. I just had a couple of quick questions. It feels to me like a lot of the energy around the FDIC insurance reform has kind of dissipated a little bit. I'm not, and I know that the vast majority of interest has come from mid-sized banks. I'd like to hear from the panel if this has already been asked. I apologize, Mr. Chairman. But is there, I'll get it all into one question. One, is there any kind of reform system that benefits all institutions from the very small to the large? And I don't know how you could do that without some additional burden sharing. That's point one. Point two is I continue to believe that better use of the Fed discount window, that's what it was set up for. But is there a way that we could encourage more usage of that didn't carry with it a mark of shame in terms of policy? And then three, I am familiar with the fact that there are a number of these informal exchanges where someone can affect leverage off some of their deposit insurance to kind of go above the 250,000 level. I know there's some informal associations across Virginia. Are there ways to even strengthen that tool? So the panel, any way to do this that benefits the whole community without undue burdens? Two, how do we deal with the discount window in a way that doesn't carry the burden of shame? And three, again, apologies if this question's been asked, how do we do these informal networks that already exist that able to raise the 250 level on a more informal basis?
Well, as a banking practitioner, Senator, I'll take first crack at the last two parts of your question regarding informal exchanges and liquidity facilities that are made available to through the Federal Reserve and and through other sources. On the informal exchange piece, bankers are creative. Bankers will swap those deposits overnight so that customers can remain protected. There's a little bit of a cost in doing that. We have to think through if we become more reliant upon that. It's not an automatic item. It takes a registration. It takes a process to do it. But those facilities are used by bankers and regulators.
Isn't that also, that doesn't burden the overall system? People can in fact opt in or opt out of using that tool, right?
That's correct. It doesn't burden the system, and it's understood, and it's generally considered to be a safe practice. Regarding the availability of liquidity tools in preventing a crisis, I think removing stigma, I think, is an important thing. I think the current Federal Reserve facility that came up after the SVB crisis has been useful. It's helped banks that had securities that are high quality assets. It's helped them monetize them or at least be able to use them in the near term. That, I think, is also helping affect a little bit less reluctance or shame in using the discount window. And frankly, many banks don't use the discount window. And I've never known a regulator, at least in the community bank space, to think about that in a challenging way or in a difficult way. I think FDIC already has more powerful tools, prompt corrective action, to address banks that are having concerns, and nobody wants to be in that PCA space.
Thank you. Others on the panel?
Yeah, I'll add to that. On the discount window point, you're exactly right. The Fed should not have to use 13.3 to provide liquidity for a banking run. This has been a problem really since the Fed's creation, and arguably the Fed had the discount window in place and more active. You might have not even seen the establishment of the FDIC during the Great Depression. So I think this is something that deserves a real serious look. As you know, Senator, there were some changes made during the Dodd-Frank Act about the transparency around the 13.3, and that has kind of added more to, I think, bankers' reluctance to use it. In addition, supervisors have historically very much disfavored it. So I think there's some balancing that readjustments that need to be done on the supervisory process to make it bankers feel that, particularly if they are seeing immediate liquidity needs, and again, these are healthy banks that are simply just dealing with a unexpected liquidity shock, that the discount window is there. Frankly,
I'd just interrupt. I'd say I know my time's expired. I do think we ought to consider some of these things, because when you've got an SVB type run of, in effect, 40 cents on every dollar, internet driven, no capital constraints are going to be enough. But thank you, Mr. Chairman. Again, my apologies for having to do this from the office.
Thanks, Senator Warner. Senator Cortez Masto of Nevada.
Thank you, Mr. Chairman. Thank you to the panelists. Let me focus on deposit swaps, because we know that any person or business with more than $250,000 has the option to open accounts at multiple banks, correct? And then they have the ability to have that covered by FDIC. But banks can easily move deposits above the $250,000 to a $1 million maximum to other accounts through deposit swaps as well, and use companies like IntraFi Network, correct? And so let me start there, because, and maybe Ms. DeVito, let me start with you here, because if Silicon Valley Bank, Signature Bank, First Republic had made use of deposit sweep companies or other options to move the big bank accounts from their largest customers to other banks, the run may not have occurred. And so I guess maybe for the whole panelists, and Mr. Frazier, would love you to weigh in, what's the role here? And at what point in time is the bank responsible for also looking at this issue and addressing it? And let me just ask, with your banking experience, Mr. Frazier, what is the role for cash dispersal and sweep accounts options? Should we be looking at this more so and relying on that private sector to engage in this, and more responsibility on the banks for doing these swaps? So maybe, Ms. DeVito, let's start with you, and then Mr. Frazier.
Yeah, thank you, Senator. So I would just point out, and I look forward to Mr. Frazier's answer, but that sort of indicates that there are a category of depositors, especially particularly sophisticated ones, who are able to access more coverage than is in statute. And so to the extent that deposit insurance serves two purposes, financial stability, but also protecting individual and small dollar depositors, it has created sort of a tiered system that I think we should look to reforms to, I think, clarify across the board so that everybody is eligible for the same degree of coverage.
Okay.
Yes, Senator. So to the extent that it could be in part a private sector solution, it is today. So banks use it. My banks use that facility, but it's usually initiated by a customer request or a customer preference to have broader coverage.
So the responsibility, or at least the banks, leave it to the customers to make that decision, and they don't.
Not all.
Okay.
So our treasury management officers would sit down with a customer and let them know about those options.
Okay.
We price them the same. We don't charge them more or less for that. That's part of our consumer protection responsibility. But it is something over time that it could be part of the deposit insurance reform or deposit insurance solution. There's merit to the idea more broadly. I'm not sure, though, to the first part of your question, though, Senator, that given the scope of what happened at the run last March, if an InterFi or an entity like that could have absorbed that kind of shock to the system, the intensity of it. And it underscores the fact that banks, if a bank has a high amount of uninsured deposits, and in our case, ours is minimal, but if it does, it is part of its liquidity planning and interest rate risk management practices, that has to be front and center. And running a bank sometimes is kind of like flying a 747 plane. You have 600 dials you're looking at every day. Liquidity is one of the most important dials. It's like your airspeed. And to lose sight of that from a risk management practice would be unheard of in almost every bank in this country. So liquidity planning is really an important part of that, and an InterFi or something like that can help in that.
Okay, I appreciate that. Let me jump on another thing that you actually talked about in your opening remarks, and this is what I think is a challenge for all of us, and you touch on it. And actually, two items you talk about are there's more shadow banks than we've seen before. Recent estimates suggest 43% of new checking and banking payment accounts this year have been opened by such non-bank entities. And then you also highlight the fact that large private credit firms are now raising money from retail investors to lend to businesses as well. And I guess my question to you is as we are looking at this from a regulator's perspective, how is it that we would then really look at the kind of the shadow banking system? What should we be considering as well, if anything, that we can be done?
Well, shadow banks, not being critical of a shadow bank
Right, no.
or a fintech
Correct.
at all. They do play a role, and they do foster innovation, and they do help all of us raise our technology game. So that's important, and they provide good services to customers. The consequence, though, is they're not part of the, let's call it the banking cycle, the banking system, where they take in a deposit backed by capital and invest it in a loan or an asset, returning a benefit directly to the community. So what's happened is we've chunked it up into different little segments. This fintech does this fintech does that. But the consequence of it over time is it's outside of the primary regulators, and it's outside of many of the consumer laws that are in place and many of the safety and soundness expectations that banks have. That's not to suggest that they're acting recklessly. It's just suggesting the fact that they're outside of the traditional regulatory perimeter in which all of us exist.
And I appreciate that. And I know my time is up, but let me just say, if we are looking at one theme for all of this is consumer protection and financial stability, that should apply to banks and non-banks together. Wouldn't you agree?
I agree with the general statement, but more specifically to the non-banks, how then is a non-bank well capitalized to absorb a loss or to be held directly accountable for its behavior? And that's not, again, it's not to say that they're not. It's just the fallback, the safety net isn't quite as deep in terms of consumer protection, perhaps, and in terms of enforcement and the ability to supervise those entities.
Thank you. Thank you, Mr. Chairman.
Thanks, Senator Cortez. And that's Senator Sinema from Arizona is recognized from her office.
Thank you, Mr. Chairman, and thank you to our witnesses for being here today. Recent bank failures, particularly the failure of Silicon Valley Bank, highlight the need to address shortcomings by bank managers and bank supervisors alike. I'm pleased this committee recently acted in a bipartisan way to hold failed bank executives accountable. I'm likewise committed to holding federal banking regulators accountable. ensuring regulators fix cultural and operational deficiencies so their bureaucracy never gets in the way of doing their jobs, and protecting the American people and hardworking taxpayers. Today's conversation on deposit insurance is an important piece of the puzzle. When the FDIC invoked its systemic risk exemption authority and protected the uninsured deposits of Silicon Valley Bank, it took action to protect the banking system from contagion risk, but it also upended the incentives to act responsibly by implying that bigger banks would be shielded from the consequences of bad decision making. So, my first question is for all the witnesses, and if you would, please be very brief in your responses. Dr. Peter Conti Brown of the Wharton School of Business at the University of Pennsylvania recently proposed increasing deposit insurance for small businesses with less than 200 employees. Conceptually, this idea could have merit, but I'm curious about how it would be implemented for pass-through businesses, where it may be harder for banks to distinguish between personal holdings and business holdings, depending on the choices the customers made. So what tools do banks have to distinguish between the two in this instance?
It's the Senator. It's the most probably complex element of any kind of targeted expansion of or trying to solve deposit insurance reform for a segment, say like business accounts or something that's tag-like. Very complicated, hard to, and it was difficult to figure out when tag was in force back at the after the last crisis. So no easy way to do it. It's something that would require a fair amount of study. I think every practitioner and every suggestion that's out there is going to struggle with that question.
Yeah, I would agree with that as well. You have the definition and monitoring is going to be very important, because otherwise you're going to have gaming that could potentially be created. I think this is something that certainly one could have depositors do some kind of verification or certification when they open their account. But again, that's another kind of administrative burden, and I don't know how necessarily effective it would be.
Yeah, I agree with the other witnesses. This is an acknowledged, I think, challenge to this approach, but one that it does seem feasible.
Well, thank you. My next question is again for all the witnesses. So again, please answer briefly. Do you believe that depositor discipline exists right now? And do people think they'll actually lose money beyond the FDIC guarantee if their bank failed tomorrow? And if so, why? And if not, why not?
I think it depends on the customer and the depositor. We have business owners that have deposit discipline that are worried about deposit insurance limits. And then we have younger customers. We have more vulnerable customers that are counting on us to make sure their deposits are safe, but they're not asking that question necessarily. So I think it depends on the constituency we're serving, but it's also incumbent upon all banks to make sure that our depositors, no matter who they are, know exactly what their deposit insurance limits are. Just briefly, during the crisis back in March, we communicated regularly and proactively with everyone, all of our customer base, as to what their limits were and the steps that they could take to ensure their deposit safety.
Yeah, I do believe depositor discipline exists. I think the existence of the run shows that. Now, is it as effective as it should be? I think that's one of the key questions before the committee as it considers deposit insurance reform. As I noted in my testimony, the way banks are resolved right now, just a very small portion of uninsured depositors actually do suffer losses. And so that's in one sense, a positive statistic in the sense that the FDICs are able to resolve institutions without incurring losses, significant losses. The flip side of it is that if there is no risk of loss, again, you've extended the deposit insurance limit far above the 250, and you're creating significant moral hazard over time.
I think the limit exists at what it is to protect the depositors who are incapable or uninterested in providing that depositor disciplining effect. I think SVB in particular showed that we might not have that calibration exactly right. There are depositors out there who are uninsured, not monitoring bank risk, but able to engage in destabilizing runs and have a lot of customer money, including workers' paychecks, wrapped up in their behavior.
Thank you. Mr. Chair, I know my time's expired. I have more questions that I'll submit for the record. Thank you.
Thanks, Senator. Senator Warren from Massachusetts is recognized.
Thank you very much, Mr. Chairman. So throughout history, when rumors take off that banks may not have enough money to cover all their deposits, depositors rush to withdraw their money. FDIC insurance was designed to reassure depositors that they will be fine, but the $250,000 cap means that bigger depositors, which can be small businesses, big businesses, nonprofits, are left exposed. These folks depend on their ability to access their money to cover their payroll, to cover rent and other expenses. So when they hear even a rumor of trouble, they rush to withdraw their money, causing a run that threatens the bank's survival. Now, why do people listen to rumors of bank failures? Why not? The cost of moving an account from one bank to a bank that is more secure is very small. So if people really are at risk for losing their money or even temporary access to their money, why not get out while the getting's good? Ms. DeVito, if a crisis hit the banking system, does history suggest that a depositor, even a very big depositor, needs to worry about whether they will be able to access their money if it's at a community bank?
More often than not, all failed bank depositors are eventually made whole through resolution or once a bank's assets are sold. That can take time, sometimes weeks, months, years, for depositors to get that money back. And that kind of lag and general disruption can be incredibly harmful to businesses, especially larger depositors who need access to their funds. So large depositors at smaller institutions would be right to worry.
Okay, so it's not a huge risk, but it's a real risk. And since 2007, about 7% of failed banks had uninsured depositors that have still not fully recovered their money. Now, Ms. DeVito, what about the giant banks, the too big to fail banks? Does history suggest that a depositor should worry even a little about deposits in excess of $250,000 FDIC cap at those giant banks?
No, the federal government has demonstrated that it will take actions to backstop depositors at the biggest banks, no matter the financial cost. It then does recoup those losses by levying increased assessments, but those are spread across all banks. So this has created a system of implicit, unlimited coverage for the largest banks.
So what that says is that when depositors trigger a run, they're actually acting rationally. These businesses flee to the place that they know their money will be ready for them for sure 100% when they need it. And while my community bank down the street and JP Morgan Chase may have the same official $250,000 insurance cap on paper, the fact of the matter is, if the two go underwater, the government's throwing the unlimited insurance life vest to JP Morgan Chase. Depositors run to the giant banks because they know the government will bail them out. So, Mr. Frazier, are the too big to fail banks paying for this extra measure of insurance?
So from a transparency standpoint, I can speak about my bank and how much we pay into the system. And, we pay on average 7.7 basis points is, I think, our premium that we last calculated. I know that all the institutions are subject to the same schedule of calculations related to the risks that are in place. And I'll get to your answer in a minute. And whether or not that deposit insurance scheme fully captures those implied guarantees and risks, it's beyond my ability to assess.
Look, you just said it, though. Everybody's getting charged the same amount for these $250,000 caps, only it turns out that the too big to fail banks are getting a whole lot more than a $250,000 caps. And what I'm worried about here is that we're seeing the too big to fail banks get unlimited insurance without paying for it. And they are getting that benefit at a cost to the community banks. How do we know that? In the aftermath of the SVB crisis, the 25 biggest banks gained more than $100 billion in new deposits in the days after the SVB collapse, while the small banks, the ones below that level, lost more than $100 billion in deposits. So how do we make sure that FDIC insurance isn't structured to give a free bonus to the too big to fail banks? Ms. DeVito, if we could provide a little more reassurance to the business and nonprofit depositors that their money will be protected by raising the insurance cap in the smaller banks, do you think they would be less likely to flee those smaller banks whenever they hear rumors of stress in the banking industry?
Yes, ma'am. That's generally how deposit insurance works. The more money you know is safe, the less worried you are about it being at risk, and the less inclined you are to engage in a bank run.
Well, I think it's time to reform the deposit insurance system so it isn't just another handout to the big guys. I think we should do three things. First, raise the FDIC limits so that banks can bank with so that businesses can bank with community banks without the threat of business interruption during a crisis. Second, make the too big to fail banks and the banks with the highest levels of uninsured deposits cover more of the cost of ensuring the stability of our banking system and the FDIC insurance fund. And third, tougher oversight to ensure that banks don't take advantage of this additional insurance and engage in riskier behavior. Thank you, Mr. Chairman.
Thank you to the witnesses today for your testimony. For senators who wish to submit questions for the hearing record, those questions are due 1 week from today, Thursday, July 27th. Witnesses, please submit responses to those questions for the record at most 45 days after you receive them. Thanks again for your testimony. Committee's adjourned. Thank you.